Looking at the Cleveland Fed's inflation projections, the CPI is expected to rise to 3.82 in August and 3.91 in September. This forecast was measured as of the last 5 days, so if oil prices rise further, we expect the CPI to rise again. We will live in a world where the percentage has risen to 4%. It can be seen that the United States is suffering equally from soaring international oil prices. Another thing to note is that the gap between core CPI and headline CPI is continuously narrowing. If the headline CPI exceeds the core CPI, it is questionable whether the Federal Reserve will be able to ignore the headline CPI. The market may again pay attention to the headline CPI, as the CPI that was thought to be in control may go beyond 4 and go as high as 5. This means that high oil prices will create an atmosphere of tightening again, which could lead to increased volatility in bond yields. So far, the structural causes of inflation have been largely resolved and the market has been predicting a clear decline in core CPI. However, if oil prices rise in this way, market uncertainty will increase in a situation that no one expected. If so, the direction of international oil prices will be important. If international oil prices continue to rise like this, what is the reason? Currently, the price of Brent crude oil is over $90 per barrel. There are 3 main reasons for the rise. 1. Reduction of production by oil-producing countries. Saudi Arabia is in the process of reducing production by 1 million barrels per day by September, and OPEC Plus has also agreed to reduce production. 2. America's growth, China's recovery. The U.S. economy is growing faster than expected, increasing demand for crude oil, and China will increase its use of crude oil to avoid recession. 3. Speculative demand. Speculative demand can increase crude oil prices by adding fundamental demand. Then, if the international oil price exceeds $100, how does the CPI we see move? The directionality between international oil prices and CPI is surprisingly consistent. International oil prices appear to slightly lead the CPI. How do interest rates and the economy fare in this situation? There are some important takeaways. Except for a few exceptional moments, movements in international oil prices and the Federal Reserve Bank's benchmark interest rate show a surprising trend of moving together in direction. If the economy is running normally, soaring international oil prices will hit the CPI and the natural mechanism of raising interest rates to control high prices will work. When there was an economic recession, international oil prices and base interest rates did not move together. Even though international oil prices were rising, interest rates were falling. Then, assuming that international oil prices become more abnormal, there are 3 main scenarios we are expecting. 1. In normal cases, a higher CPI acts as a background for an interest rate increase, leading to an interest rate increase. 2. When quantitative easing is in effect, there is no change in interest rates because interest rates must be kept low for the economy. 3. When we are going through a recession, interest rates are lowered when international oil prices rise. The future movement of international oil prices, the fluctuation range of CPI, and furthermore, how interest rates move will play a key role in accurately understanding the current situation. Thank you and happy investing.